The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule, and that's all the rules there are. I mean, if you buy things for far below what they're worth and you buy a group of them, you basically don't lose money.
The three most important words in investing are margin of safety. The best investors in the world have such great track records, in large part because they've avoided catastrophic losses. The maths on this is really quite straightforward. If you make a 25% loss and $1 invested goes down to 75 cents, you then need to make a 1/3 return to get back just to where you started. And obviously, the bigger loss that you have, the more significant the rebound needs to be to kind of repair the damage. If you lose 50 cents on the dollar, for example, you then need a 100% gain to go from 50 cents back to $1. And if you experience a catastrophic 90% loss on any given investment, you then need to 10x that remaining 10 cents on the dollar just to get back to where you started. And there are many other advantages to investing in situations where there is a large margin of safety or a lot of protection from downside. Typically, that means that you're buying a company for significantly less than perhaps the physical assets the company owns. And if the gap closes between where you bought that particular company and its true value, it can not only protect from downside, but it can also create some additional upside in your investments. Now, a margin of safety can come in many different forms. It can simply be the ability of a business to generate a lot of cash. It could be physical assets like real estate, or it could even be the capital allocation skills of a management team. So in this video, I want to go through 4 different examples of kind of different forms of a margin of safety that you might find when researching different stock market investments. So if you enjoy the video, be sure to subscribe, but without further ado, let's get straight into it. Now, the first, the simplest, and probably the most common approach to finding a big margin of safety with any given investment is simply buying it for less than its present value of future cash flows. Now, this is something I've covered on the channel multiple times. If you look at the 2 most popular videos on this channel, they are both running discounted cash flow style valuations on public companies. And if we expect a business to produce a certain amount of cash into the future, that means we can come up with a value, an intelligent price to pay for that company today in order to earn a good return. And put very simply, if the market offers us the shares of that business at a significantly lower price than what we view those cash flows as being worth to us as an investor, that gives us a phenomenal margin of safety. Should those cash flows not materialize as we perhaps anticipate that they will, that gives us a lot of protection from loss. And there are countless examples of these types of investments that have happened over the years. Often these big discounts to the present value of future cash flows coincide with some sort of short-term concern about the future prospects of a particular business. Take Warren Buffett buying Apple very cheaply in 2016, for example. That was at a time where people thought we had reached peak iPhone sales and that Apple would no longer be able to grow their business, and that really reduced the share price or the multiple of earnings at the very least quite significantly. Clearly turned out to be quite incorrect, and Apple turned into a very successful investment. You could also take something like Chipotle Mexican Grill, who've had a couple of different kind of food hygiene scares over the years, and that also has resulted in, from time to time, very cheap share prices. You could also take something like Microsoft in 2010 to say 2014. Microsoft had kind of finally burned off the great excesses in valuation that it reached in the dot-com bubble in the late 90s and early 2000s. And again, it was just kind of a very unloved stock that had gone sideways for a long period of time, but the underlying business had grown and was expected to continue to grow into the future, and it made it very cheap on a discounted cash flow type basis. Now, the second type of margin of safety I want to talk about is some form of tangible assets, and this can come in many different forms, but a very simple example would be something like real estate that can easily be resold to another owner. So take something like Seritage Growth Properties, for example. That company has had negative cash flows for a long period of time, but still has quite a significant asset base and has been able to keep its operations running by selling some real estate to generate cash to continue redevelopment projects and various things that they have on the go. Seritage specifically has kind of gotten to a point now where they've sort of thrown in the towel and it looks like they're going to liquidate the whole thing. But it's a very good example of a margin of safety. The original investment thesis with Seritage was that they could sell some properties, funnel the money into new property developments, lease those properties out, and then get like a cash flowing, very nicely developed real estate portfolio. And unfortunately for Seritage, they really haven't been able to pull that off, at least at an overall portfolio level. They've definitely redeveloped some properties that have worked quite well, but having that very diverse and valuable asset base relative, at least to the market price at which investors could have bought shares, has really insulated investors from permanent loss over the past couple of years. It is worth noting here, though, that there are forms of tangible assets that are not particularly valuable in a liquidation type scenario. Take a very specifically tooled car factory, for example, maybe a factory owned by the Ford Motor Company. Now, sure, that particular factory might sit on quite valuable land, and maybe that has some value to another buyer, but if another car company was to come in and purchase Ford's assets, for example, a lot of the value for Ford that sits in that factory is in the money that they've put towards very specifically tooled kind of pieces of equipment in the factory to be able to create Ford style components for their cars. And that is really not going to be of much value to some other car brand who has their own, design specifications and maybe different types of looks and all that sort of stuff. So although tangible assets in a liquidation can be valuable and can provide a margin of safety, ideally you want them to be the type of asset that is valuable to a wide range of owners. You don't want a lot of tangible assets that are really only valuable to the company that currently owns them, because if something goes wrong with that company and they need to dispose of those assets to try and generate some cash, they're probably going to have a pretty hard time doing so. And buying businesses at a discount to their tangible assets is not unique just to real estate companies. It can come in many other forms. In financials, for example, if you were to look at a bank, if a bank really wanted to, they should be able to sell off their loan assets and that type of thing. So you can really hunt for this in quite a wide range of industries, and it's a very nice way to try and find downside protection and a margin of safety. Now, third is another quite simple one, and that is cash. However, there are some nuances to this particular form of a margin of safety, which is ideally you want that cash to be actually used for something intelligent. So often if you were to look at a very stereotypical Japanese company, for example, Japanese companies over the years have built up a reputation for having enormous piles of cash. And if you back out the value of that cash when you are doing your discounted cash flows and so on to try and value the overall business, often those companies can look really cheap, because you're not only buying the cash flow generating enterprise, but you're also getting a balance sheet that's loaded with cash, and you're kind of getting that for free. So it makes the value of the business kind of look a little cheaper. But in the case of that type of company in Japan, for example, for many years that cheapness has been a bit of a mirage, because the cash has always sort of just sat there and it's never actually been distributed to investors. So when you buy into one of those companies, sure, some of your money is going towards cash flow generating, hopefully high quality business, but a lot of your cash is going towards just sitting in cash in a bank account, or maybe in some sort of short-term investment, really not earning a lot of money. But there are times when cash can provide a huge margin of safety. Again, take Warren Buffett's investment in Apple a few years ago. They had an enormous pile of cash building up from many years of successful business operations. But the difference there is they had quite a clear plan in terms of capital allocation. They were going to funnel money towards share repurchases and also increase dividends over time, which resulted in this effect on the shares outstanding, that the shares outstanding came down dramatically over the past few years, and each individual share remaining in Apple that Warren Buffett in this case owned represented a larger and larger percentage ownership in the company. We can also see this kind of cash margin of safety in some very cyclical businesses. So something like an Australian coal miner at the moment, or even a big oil company in the US. These are very cyclical, often quite unpredictable businesses that maybe you have some sort of view into what they might do in the next year or so, but it's pretty tough to figure out exactly what they might do in year 2 or 3 or 4 or 5. But in some cases, if those businesses are paying very, very large cash dividends, for example, very early in your investment, that can take a lot of risk off the table. If a company's paying a 20, 30, 40, 50% special dividend because they've had some very, very exceptional year, and you get a lot of cash out of that thing very, very quickly, you take some risk off the table. Again, you get a lot of money back early, and it's a really nice form of margin of safety. Now, the final one here is simply to buy a very high quality business. And when I say very high quality business in this context of margin of safety, I basically mean two different things. One, that it tends to be quite high margin, so that if the business does stumble in any sort of way, it maybe goes from a 20% operating margin to a 15% operating margin, for example, which sure is a significant hit to their profitability, but it's not going from, for example, a 3% operating margin to a 1% operating margin, which would mean they lose 2/3 of their profitability and have a very significant hit to their cash flows. So here we're really looking for a higher margin business, or at the very least, maybe a lower margin but very stable margin business. Something like a Costco perhaps, because cash flow over time really does heal a lot of sins. Two companies that come to mind in this area are, again, Microsoft. This time, if you had purchased Microsoft in 2000, that would have been quite a major era in terms of looking for a margin of safety from a valuation perspective. Microsoft got extremely expensive in the tech bubble, and it took many, many, many years to kind of burn off that big excess valuation. But the entire time, Microsoft was producing a lot of cash flow. Under the hood, it genuinely was a very high quality business, and although your returns over the next decade or so from Microsoft were something approaching zero, there was never really any material chance of Microsoft going to zero. They weren't heavily indebted, they didn't have negative cash flows, and it, at the very least, allowed investors in that company, even though they had made the mistake of paying too much, it allowed them to survive. Another much more recent example would be something like Meta, obviously previously named Facebook. The stock is down significantly in the last year. They've undergone a huge change in terms of their business philosophy, their capital allocation, and the amount of money that they're spending on things like the metaverse. And it's really yet to be seen exactly how that plays out. I don't have a particularly strong opinion on it, other than, for me at least, it kind of just goes in the too hard basket, and I sort of move on to looking at other things. But barring a huge asteroid hitting Earth or something, again, similar to Microsoft, there really is basically no chance that Meta ever goes to zero. Again, they have a very cash flow generative business, even though they're taking a lot of that cash now and spending it on some of their newer ventures. Up until very recently, that underlying business has allowed Meta to never really have any debt at all. They have one of the most pristine balance sheets you will ever find, and it even allowed them to kind of initiate a share repurchase program and start buying back some stock when at least they viewed the share price as being cheap. So those are 4 different versions of a margin of safety in your investments that I hope you found useful. We've got buying a business at a big discount to the present value of future cash flows, buying a business that has a lot of tangible and easy to sell assets. Thirdly, buying a business that has a lot of cash and short-term investments, and ideally has a plan to allocate that cash and short-term investments in a way that is intelligent, whether it be buybacks or dividends, or maybe even an acquisition that you think makes a lot of sense. And fourth and final, we have buying a high-quality business, ideally one with high or at least very stable margins, and one that when you combine that ability to generate cash flow with a very solid balance sheet, has very, very, very little chance of ever going to zero. So thank you very much for watching the video. If you think there are any sort of forms of a margin of safety that you think I've missed, definitely let me know down in the comment section below. But that's it for me for this one, and I'll see you in the next video. Cheers.